Market observations for the wider Sydney area. Now, in this conversation, I'm going to be doing something a little bit different. I'm going to be looking at multiple local government areas. There are some that are firing as of right now, and there are some that are emerging and looking quite strong in the months to come. I'm also going to be going down to a suburb level, a street level, and then looking at some individual properties that we might be targeting in our Sydney investment process. So let's dive right in. City of Ryde is going to be the first local government area I'm going to be digesting. Okay, I'm really liking what I'm seeing here from a research perspective. I also know the area quite well, in terms of knowing the streets, living close by to the area, so I can speak to the data and potentially provide a human layer behind the scenes. I'm also going to be touching on the city of Blacktown and even the Sutherland Shire. The Sutherland Shire was the local government area that did emerge first, with Sydney coming back onto the scene from a data perspective around 6 months ago, and then it has been followed by the middle market, the affordable heartland of Sydney heading out west. And I guess it probably does focus around the Blacktown area, and then even, as mentioned, out to Penrith, and then into the mid to higher socio markets on the, the North Shore, not the lower North Shore, but the North Shore around the Ryde area. Some really interesting pockets that have emerged there very strongly towards Macquarie Park, etc. So I will go into those individual suburbs in a moment. Look, property investment needs to be considered as a science. It's incredibly important that we look at the data. Okay, we've got emergent AI. We've got some really cool stuff happening in the technology space. We're pioneers here. We've been doing this since 2011. We're leading the charge in terms of algorithmic purchasing, market asset selection. But then also, this video is designed to be giving you that insight, giving you that understanding, empowering through that knowledge, but then also practical takeaways where we can go away and implement. So this is a science. This is going to be the framework for talking through today. Number one, we need to quantify the overall opportunity. There's no point in it being a good time to buy in a bad, wider, long-term market. If the scope or quantum of the opportunity is not really up there at a national level, we need to go elsewhere. So jumping in, really good employment diversity. You would expect in a city like Sydney, a middle ring suburb like local government area, like the city of Ryde, you'd expect a lot of employment diversity. You've got a university hub, you've got train hubs into the city, you've got really good income growth, great commute times and employment diversity. This is excellent across the board. You don't get much better than this across the country. Employment, big tick. Now, unemployment. Look at the timelines here, guys. We're not happy with the data ingesting from ABS yet, so this should have another 12 months added onto it. Okay, unemployment rates have come down, record low unemployment. This is an exhibit of that, where we did have that spike through COVID. It has recovered very nicely afterwards. So no issues there around unemployment. Now, this is giving you some context. So we're really put a lot of focus on what is going on in terms of new construction in the pipeline, new investment in utility creating endeavours. We look at any project over 50 million. There are a few smaller ones that are added in there, just for completeness' sake. But some big ticket items around private and then health investment. Look at the number two item there is the Ryde Hospital redevelopment, 479 million. These are all in different states of construction, even slight completion, recent completion, and even early stage announcements. Very large spends through the Macquarie Park, which is an established business park. A lot of nationals, international companies sitting there, a lot of employment. This is a focal point of transport and employment. A lot of people commuting towards the Macquarie Park area. I love to see the continued diversity. It's one thing to be diverse now in terms of employment, but the new projects in the pipeline need to continue and even amplify that diversity and not, focus it more towards one area. And I love seeing investments, particularly in these middle rings of the large capitals. I love seeing investment in health. What does this mean? Well, I'm going to put it in context first, because we do have some smaller regionals nationwide that have off-the-chart spending on new projects per capita. Billions of dollar projects spread amongst small populations. We also have some other, regionals or other smaller locations that have, good, $20,000 type spend per capita And to put that in context, this is $102,000 per person projected spend on new projects going forward in the current announcement pipeline, and that is extremely good. It doesn't get much better. These are small sample sizes. This is a capital city, and this is really punching above its weight, and that's why I really like the City of Ryde area. Now let's go in a bit deeper. Probably won't spend too much here. Very good servicing by current services. You know, your Bunnings, your supermarkets, your transport hubs, etc., as you would expect here in a key international city. Projected capital growth, very high, excellent on a national level. Right, we're pushing 2% in recent years, and that's expected to continue. You know, you think about overseas migration coming into Australia, it's probably at a higher price point than that demographic would emerge and enter into the Australian economy at, but it definitely has a trickle or a roll-up effect where, people might have been in Australia a few years, they've done quite well, the really boots have hit the ground and they're rolling. They might be gentrifying and moving into these areas. So you'd expect that population movements would have a strong positive impact from overseas into this type of suburb, but probably not directly. It is a trickle-on effect. But very strong population growth forecast for the next 3 years nationwide. So overall, the scope of the opportunity is very good. There are better, but you can do a lot worse. Okay, City of Brisbane, area of inner West Sydney, these are two areas that we're comparing to. Probably slightly better opportunities in Brisbane and maybe in parts of the inner west of Sydney, but this is a volume, large LGA that is looking very good, and we've seen the reasons why. So, scope of opportunity, I'm very comfortable with. Now let's try and determine, is it the right time to buy there? Days on market, shortening, tightening very strongly down to around 20 days on market. So we have a lot of pressure, a lot of demand and a lot of turnover occurring in quick succession. Okay, very healthy turnover on the buy side. The percentage of immediate sales is slightly lower than average. Okay, so people are still taking their time. A couple of weeks, we saw 3 to 4 weeks to purchase a property. Not really a huge amount turning over on listing. Okay, so it's not a really high pressure market like, I guess parts of Perth and Brisbane at the moment, but we do have pretty low days on market as a whole. Why would that potentially be? Well, Sydney is the market in the country that has the most auctions. How long do we typically see the average auction listing last? Well, 3 to 4 weeks. Okay, listed, the sales agents running around like a headless chook, gathering all the indications of interest, getting people registered for the auction, getting them through, and then we have the auction day usually 3 weeks after the listing was originally, and then you might have auction clearance rates, what are they, 60, 70%. That would probably be a lot to do with the days on market there now. It doesn't really get lower than that in the Sydney market, so this is to be expected. We're seeing a lot of price pressure from those two metrics. Sold inventory, quite stable. There's definitely no increases here in sold inventory. One really important note, we have a lot of unit stock in the City of Ryde. As you know, over many hundreds of millions of dollars worth of purchases through Ripehouse Advisory, directly with very sophisticated high net worth and time-poor professionals, I guess. We have not bought one unit. We've bought many unit blocks, not one unit. We are looking at the City of Ryde for houses, okay? Land appreciates, buildings depreciate. We are buying the land. We want a 3-bedroom, 4-bedroom house, most in demand in the streets that they are most in demand of, staying away from the unit clusters. Okay, what's to stop them coming in and putting 100 units next door to yours? Suddenly yours is very second-hand very quickly. So we have to look at this red bars here. This is showing us the number of houses that have on the market, the inventory of houses, and we can see there is not many houses across an entire local government area. Days of supply. This for me is probably the most important demand-supply ratio or metric. Very important to look at this. And it is trending upwards. That would suggest to me we've either got lots of supply hitting the market, which we just saw that we don't, okay, or demand might be slowing slightly, which potentially is the issue here. Look, to be perfectly frank, we're still well and truly under 50 days of supply. This is still a very tight market. This is a slight trend line upwards. If it was to continue up to here, I might have some issue. Remember, we're looking at the red line for houses. For me, this is pretty normal after we've had a very strong contraction. Anything around that 30 to 40 days is still a very heated, tightly supplied very strongly demanded area. Okay, so I'm not seeing any real issues there at the moment. Asking prices, look at this zigzag. Let's put it in context. This zigzag looks dramatic, but it really is only, I'm just doing the maths in my head, about sort of 5 or 6 or 7%, fluctuation, which is in the big scheme of things of what's gone on in Sydney, particularly over the last 12 months. This type of fluctuation is actually probably quite a bullish sign. It's definitely, you draw the line through the middle and it's a consolidation across the board with a little bit of fluctuation. This could be just a couple of, higher asking price listings, lower asking price or listings that cause this. So I'm not reading anything into that yet. So I would suggest a consolidated or flat entry point into this market. Housing prices have stabilised as well. So we'd expect our discounting to be the same. We've come off a period of very strong price growth. We've come off and had a blow-off top here. We've had a pullback contraction, and it's a healthy contraction. It's 15%. And then we've had a nice consolidation period of, almost 12 months. Okay, that for me shows some really nice strength. That for me is showing that this might be a nice entry point into this market. Vendor discounting, we've seen the formula, the asking price and the sold price. Now we're seeing the output of this. Look at houses. Okay, I would expect this to start trending downwards. And I might like to see a couple of months of this trending downwards just to really get some confirmation of our entry point into this market. Let's have a look what's happening on the rental side. This is trending the wrong way. Days on rental market. It's taking longer and longer to rent properties. We'd expect that to now start translating into high vacancy rates, which it is. Vacancy rates trending the wrong way off a high base. I like to see vacancy rates at under 2%. This is coming down from 3.5% now to over 4%, and it's trending in the wrong direction. With the days it takes to rent a property increasing, then expect this to continue. For me, I don't like this rental health. This is a very strong signal to me that we don't have that underlying backbone of a market, particularly for investors. Rental yield, well, that's popped back up again, so we may have seen an environment where prices have been stable, and as we'll see in a moment, rents have been increasing. But look at the yield here, guys. This is going to be the outcome of this conversation. The buy side looks very good. Rental health on a national level is extremely weak. Would you pay $2 million for an investment property and get 2% yield for it? Okay, what's that going to do to your cash flow position? You might be able to have on a high income, and you might love the depreciation, but remember, depreciation, tax savings, that's 30 cents in the dollar. Okay, you're still having to pay the dollar in the first place. All right, and you're paying the dollar not necessarily out of your pocket, but you're paying it in terms of the yield that you are achieving on your asset. 2% yield if you're lucky. Well, I would expect 5 or 6% yield on a blue chip investment property in Brisbane or Perth if you wanted capitals. Even higher yield than that if you're okay with regionals. So for me, you cannot really beat the size of the growth opportunity, the long-term prospects of the city of Ryde. You cannot really beat the entry point from a buy-side perspective, the buying health of the market. But we're looking at an entry point around the $2 million mark that we saw in investment-grade houses, and the yield you're going to get on that is minuscule. All right, it's very low. Now, before I go into the other local government areas in more detail, I did want to probably provide a little bit of context, okay? Because we've talked about the city of Ryde. For me, I'll demand more from my investments on the rental side of the equation, on the yield side of the equation, but the buy side looks very good. So if you had a very high income in your family, you had strong aspirations for equity, net worth production, and I'm talking probably $500,000 plus in terms of household income, then this type of investment may work really well for you. The blue chip long-term capital growth stayer. For many of us on lower incomes than $500,000, potentially we'll be looking in other states. So this is definitely not a recommendation to go and buy in Ryde, but it is probably the pick of the bunch at the moment in terms of capital growth potential, pure capital growth potential in the city of Sydney, the wider city area. Where are some other local government areas that we might be able to draw our attention? Now, the analysis that we're doing here, I'm about to jump into finding these local government areas and suburbs. We apply what we call a Ripehouse R-score. So it's a combination of many different data points. We've got machine learning AI running over the top of it. We've been doing this since 2011. And since 2018, we've generated compounding annual growth rates, so each year, year on year, of 17.7%. And that's over many hundreds of millions of dollars worth of purchases, and it performs in downward trending markets. So this is a live update from the 31st of the 5th. Once a month, we have our systems automatically generate these results for us. There's no manual entry. It's looking at the results, looking at the suburbs. We generated 4.1% capital growth across our approved locations in May. Across the last quarter, 6.2% total, and 2022, 16.2%. Okay, so that's what we're talking about here. That's the City of Ryde. The City of Ryde is right up there in terms of these capital growth fundamentals. We can also see that New South Wales is emerging very strongly behind Queensland. It's number 2 in terms of emergent states. Okay, so very heated WA market, very heated South Australian market. The level of buying opportunities in those states is diminishing, whilst Queensland and New South Wales is really pushing forwards. Okay, and overall we do have almost 300 of our top 1,500 suburbs in New South Wales. So I'm doing this type of analysis in the City of Sydney. We are in a great spot in terms of capital growth, but we need to be fussy about the yields. So what I've done here is I've come in and used our private, internal platform. We use this for doing the advisory with our clients, and I'm happy to show you this screen here because we're not active in the City of Sydney markets, but we're still going through the motions. We are still giving, an insight into these markets if it is somewhere where you'd like to buy. I think that's very valuable in doing so. So what I've done is I have done some work before we've come into this conversation. I'm not going to do it here on the video because it will disclose some of our locations we are buying in, and that's information reserved for our private advisory clients. But I did locate the highest potential Sydney local government areas. And we have the City of Penrith, the City of Blacktown, Sutherland Shire, City of Ryde, as we've seen before, and we've got a big buy signal for the City of Ryde at an LGA level. You can see the breakdown where we do have quite a few spread out across the mix, but only a couple here from the City of Ryde. Now, I do need to draw your attention here as well to the vetting procedure. So many of these suburbs have been rejected due to too much supply, lack of density in the suburb area, or a variety of density. Some small units, some larger block sizes, and then in the same suburb area, many acreages. So they're averaging each other out and the signals are confused. All right, so we need to be fussy about the data, the technology, and then the human side, the confirmation from that human perspective. So we've got the the suburb of Denison West in the City of Ryde as our standout. And I'm going to use this as a case study, guys. Not many properties available to purchase there. There are some potential in and around there. And I am then going to also come into the City of Blacktown, which might offer some very accessible, sub-$1 million investment properties in houses, which might be something that could get the yield working in our favour at a national level. Some of the standouts here from Ryde, okay, and I'm going to probably talk through this in a tabular format now. The suburb of Denison, 2.3% yield, so slightly above the local government area. 87% owner-occupiers, very strong. Owner-occupiers have a longer tenure time of ownership, so lower stock turnover, generally therefore lower supply. It generally results in, a higher quality of dwelling or stronger gentrification drivers where owner-occupiers are taking pride in their properties and improving them. But we may actually be on the side of the coin where we have too many owner-occupiers, not enough tenants to have consistent and reliable rental markets. And we need obviously rental markets that are healthy from a ownership perspective. I actually like between 60 and about 75% as the optimum owner-occupier rate. I'm actually more comfortable dropping below the 60% owner-occupier rate at a suburb level and then targeting individual street locations in that suburb that have the higher owner-occupier rate. So that's probably going to be actually perceived as a negative thing in this case. We've seen good rental price growth, okay, and we've got continued tightening in our days of supply. So we've got all the indications across the board here of a growth cycle just starting for Denison West. This is a very strong entry point. Okay, and the rental market here, we saw with the local government area, it wasn't too healthy. Well, in this suburb, the rental market is healthy, but there's not many renters. The data is very volatile. Okay, so we can't really rely on that health signal very strongly. This is really buying a capital growth asset and not really a yielding asset. What I've also done is I have now filtered in the city of Blacktown and the city of Ryde. This is once again our internal property platform. It's listed all on-market properties. We've removed any off the plan house and land packages. We've done some automatic filtering here around the wrong property configurations, the wrong bedroom configurations. Like we don't want a studio apartment. This is a house that's 3 or 4 bedroom, and we've removed anything in high public housing enclaves, etc. So we are left with a very small number of properties. Some of them have been on the market, for a couple, this one just landed on the market today. Some of them have been on the market for some time, hundreds of days. And some of them are likely to be, or very unlikely to be, in distress. Some of them have been discounted, in this case by around 5% in the last 11 days. So you need to have this sort of intelligence behind the scenes to be able to make this decision making. Some of them have been on the market for 2 weeks. They've potentially had indications prior to an auction, and they've put their asking price up. Okay, so it's really interesting, and in seeing this type of data and understanding it. One thing with this type of suburb in Sydney is there's a lot of withdrawn prices, or inquire within type prices, or auctions far higher than any other rural local government area. So, we're firing on all cylinders. There's a few of these in great suburbs here, very high R scores, great land components. Okay, the street location is something that we need to get right as well. So coming into Denison East is a funny little suburb. Okay, it's not many dwellings. It's about 500 dwellings. About 1,500 people living there, and it's black and white. Okay, so we have one market where we've got strong or above average owner occupiers, and the other side of the suburb has lower than average owner occupiers. All right, generally, it's all houses, there's no units there. We don't have many sales. It's a smaller area, smaller suburb, but we do have probably the south cluster here with a higher median price. And then we have not many rentals, once again. Remember, we've only got one in every sort of 10 or 15, maybe one in every 8 or 10 properties as a tenanted property. So we don't have a huge amount of rental comparables. But you're on a $2 million plus property getting $550 a week. So you really have to be doubling down on capital growth here without any real consideration to rental yields. And in this pocket in the south, we've got extremely low rental yields. No public housing to be considered in this area. So definitely, if you're wanting something that is very strong capital growth without any consideration to yield, look towards Denison West, probably number 1, then into Denison East, and then into West Ryde. These are all the areas that are emerging at this sort of mid to upper market Sydney. I wanted to go in, and I have done this search prior to jumping on here and filming this around the city of Blacktown. What are the strongest properties in the city of Blacktown for our reference? Sorry, the strongest suburbs, sorry. Before I do go into these strongest suburbs in the city of Blacktown though, this is at a sub-$1 million, quite accessible entry point. I did want to mention that this is general information only. If you'd like us to apply this research to your circumstances and then potentially even help you to purchase your next investment property, there is a link in this content down below to book a discovery call, a 15-minute discovery call with a member of my team, just to work out if we are a good fit to work with each other and to help each other. I guess so. Let's jump into this information. The city of Blacktown, I have prioritised and ordered the suburbs, and there are a few that score a little bit higher than this in terms of capital growth and entry point window, but the yields on price points on those were once again very similar to Ryde. So I did choose this suburb, which is Ropes Crossing, because the data is looking excellent and the price point is just under $1 million. So let's have a look at sold prices. $865,000 median. It is surrounded by a number of cheaper median prices, but it is also to the north some larger, lower density suburbs at $1.5 million. So it is the middle market of Blacktown. Owner occupier level 72%, so really sort of spot on there. It is only one metric that we would look at. Vendor discounting is sort of break even at the moment. Yields 3.6%, so it is higher or similar to, really bullish, strong signal here. It is a similar yield to the suburbs close by that are almost half the price. So at 865,000, we've got a 3.6% yield. And then next door, we've got a 3.4% yield at a suburb at 586,000. Okay, so that's a really strong sign. A good yield at a higher price point shows a lot of strength there. 2.7% vacancy rate, so about in line with the LGA average, probably just on the higher side. For me, I'd like that to be a little bit lower, but we can't be too fussy in much of Sydney. You know, that's about average. Under 3%, I guess, is considered okay. And the Markle cycle, look, 92 out of 100. You're really in the top 8th percentile of all suburbs in the country. And we can see this cluster over here, these three suburbs are really leading the LGA fourth. So I'm really liking this suburb in terms of its context to its surrounds. This suburb, now we've got a few more dwellings to play with. So we can really see how the street level analysis does help us to target those sweet spots that we call them. You know, the west area of this suburb has more owner-occupiers. Stay away from the Wilmot side of this suburb. It doesn't have enough owner-occupiers. A few units. Remember, we want to buy a 3 or 4 bedroom house in this suburb. Stay away from the streets that have more units. Not really an issue here. Now, there are some suburbs. So this Wilmot side has lots of tenants, a few units, quite a few units, the most units in the suburb, and also the highest purchase prices. A really unique combination. I'll definitely be focusing my attention on this western side of Ropes Crossing, potentially just these two street clusters here. Rental prices, lower rents over in the west. Lower yield, so really it is now moving down to this southwest pocket of the suburb that I'm sort of focusing my attention of. And, you know, some public housing here in the north, but nothing really to be concerned of. So it really probably is this middle to middle south part of the suburb that I would be primarily focusing on, if not into the west. And staying away maybe from the Wilmot side, which we did see as the cheaper suburb to the northeast. So hopefully that's been a useful case study for you guys. Let's just summarise. City of Ryde, City of Blacktown, Penrith, Sutherland Shire. That will be my 4 LGAs. For me, whilst there is still some good growth signs in many of these local government areas, at a national level, it's still not giving me the comfort to buy. I'm still focusing on Brisbane, number 1. And I'll be doing a deeper dive onto some of the key growth markets in the Brisbane area in the next couple of weeks. Keep an eye on this. If we start seeing rents going through the roof, yields dropping under 2% in these key investment markets, and we want to see some rental and yield growth in these markets over the next 3 or so months, maybe we might be coming into Christmas at a 4% yield in these suburbs, 3.5% to 4% yield. That would be at a national level a buy signal for me at the $1 million price point. Let us know once again if there are any comments, any area requests, research requests. Subscribe to the channel, hit the bell icon, and if you would like to talk to us and our team, book a 15-minute discovery call in the link below. Thank you.